The numbers blinking on your screen right now are not just digits, they are a visceral, screaming testament to the brutality of the financial markets when expectation collides head-on with a liquidity vacuum. As we speak, SMX, Security Matters Public Limited Company, is trading at $126.01, having shed nearly 31% of its value in a single trading session. To put that in perspective, while the broader market might be content with 0.5% moves, SMX is currently decapitating nearly a third of its market capitalization in hours. If you're watching this on your trading dashboard, you are witnessing a textbook capitulation event, a moment where the floor falls out and the bid side of the order book simply evaporates. This is not a gentle correction. This is a repricing event that demands your absolute attention because it tells a story far deeper than just a bad day on the NASDAQ. Most investors coming into SMX carry a very specific, almost romanticized expectation. They see the headlines about blockchain, about supply chain transparency, about molecular marking technology that can trace cotton from a field in Egypt to a t-shirt in New York. They see the phrase, the Internet of Truth, and they imagine they are buying into the ground floor of a technological paradigm shift that will become as ubiquitous as the barcode. They expect a growth trajectory that mirrors the early days of Tesla stock or Nvidia stock, where the technology eventually vindicates the volatility. That is the expectation, a bumpy road to eventual glory. The reality, however, is significantly colder and more mechanical. What you are seeing today, this 30% drop, is likely less about the failure of the technology and more about the mechanics of market structure and capital raising in the microcap space. The reality is that SMX is currently caught in a violent tug-of-war between genuine industrial progress and the punishing mathematics of dilution. When a company with a low float and high burn rate announces equity purchase agreements or convertible notes, as SMX has dealt with recently, the market reacts not to the quality of the product, but to the influx of new supply. The selling you see is the market digesting the fear that existing shares are being devalued to keep the lights on. This gap between the story of the company, saving the world's supply chains, and the stock of the company, a financial vehicle subject to supply and demand, is where fortunes are either made or incinerated. To understand why this is happening, we have to look at the anatomy of this specific decline. In the last few weeks, SMX surged over 200% on news of successful pilots in the cotton industry. Momentum traders, likely using Robinhood or SoFi Invest apps, piled in, chasing the green candles. This created a fragile liquidity structure where the price was propped up by short-term speculation rather than long-term institutional accumulation. Today, we are seeing the unwind of that trade. The volume profile suggests that as soon as the stock broke below the $160 level, stop losses were triggered in a cascade. This is a phenomenon often seen in accounts managed through interactive brokers apps or fidelity trading platform setups, where algorithmic stops are tight. Once those levels breached, there was no institutional bid to catch the falling knife, resulting in the free fall we are witnessing right now. Now, I want you to pause and consider the environment in which you are engaging with this asset. If you are sitting there with your Schwab Intelligent Portfolios open in one tab and a speculative chart of SMX in the other, you are straddling two completely different worlds of finance. On one side, you have the calculated, diversified approach of Fidelity Wealth Management or Fidelity Mutual Funds, designed to preserve capital and grow it slowly. On the other, with SMX, you are in the wild west of individual brokerage trading. This is not the slow compound growth of Fidelity ETFs. This is high-octane, high-risk speculation that requires a completely different mindset. You cannot treat SMX like you treat Apple stock. With Apple, you sleep well at night knowing the cash flows are massive. With SMX, you are trading a binary outcome. Either they become the standard for global verification, or they dilute shareholders into oblivion. Let's challenge the prevailing narrative that this drop means the company is dead. That is the lazy analysis. A contrarian view, one that might force you to rethink your position, is that this volatility is the price of admission for a company attempting to commercialize deep tech in a high-interest rate environment. The drop today takes the stock back to levels that might be considered distressed, but if the technology is as robust as their recent PRs about cotton and gold suggest, this could be a massive dislocation between price and value. The market is pricing SMX as if it will run out of cash before it gets a major contract. If they sign a major commercial deal tomorrow, this 30% drop could be erased in 10 minutes. That is the tension. You are not betting on a stock chart, you are betting on whether management can bridge the gap between pilot programs and commercial revenue before the market loses patience. It is crucial to understand the mechanism of online investment in 2025. The speed at which information travels and the speed at which retail capital moves has accelerated. When you use investing sites or invest online through a portal like SoFi Active Investing, you are part of a herd that moves instantly. In the case of SMX, the news cycle regarding their reverse stock split played a massive role. Reverse splits are generally seen negatively. They are often a desperate bid to stay listed on the NASDAQ. SMX recently executed a consolidation to boost its share price. While this kept them compliant, it also reduced the float, making the stock significantly more volatile. A low float means that it takes very little volume to push the stock up 50%, but it also takes very little selling pressure to crash it 30%, exactly as we are seeing today. This is the double-edged sword of trading post-split microcaps on platforms like Robinhood stock trading. Let's shift gears to what SMX actually does, because amidst the red numbers, the business model is fascinating. SMX is in the business of digitizing physical objects. They use a proprietary technology to mark materials, solids, liquids, gases, at a molecular level. Think of it as a DNA marker for inanimate objects. This marker can be read by a special reader, and the history of that material is stored on a blockchain. The implications of this are staggering. In the gold industry, they can prove that a bar of gold was not mined in a conflict zone. In the fashion industry, they can prove that the cotton in a pair of jeans is actually recycled and not virgin cotton picked by forced labor. This is the Internet of Truth. They recently announced a breakthrough in cotton traceability, where their marker survived the mechanical recycling process, shredding, spinning, weaving, and was still readable in the final fabric. This is a holy grail achievement for the textile industry, which is under immense pressure from regulators to prove sustainability claims. However, great tech doesn't always equal a great stock. The disconnect we are seeing today is likely due to the financing of this vision. To deploy this tech globally, SMX needs partners and capital. They have announced equity purchase agreements, which essentially allow them to sell shares to raise cash. For an existing shareholder, this is dilution. It means your slice of the pie gets smaller. When you see a drop of this magnitude without a specific negative news catalyst, like a failed product or a lawsuit, it often points to a capital event, shares being introduced to the market, or the anticipation of it. Smart money knows this. Institutional investors using Fidelity brokerage services or Interactive Brokers trading terminals can spot these dilution cycles miles away, and they will often short the stock in anticipation, exacerbating the decline. This brings us to the psychological state of the shareholder. If you hold SMX, you are likely feeling a mix of confusion and fear. You read the news about the cotton pilot and felt validated. You saw the stock double and felt genius. Now you watch it crash and feel foolish. This emotional cycle is exactly what the market preys on. It shakes out the weak hands who bought the hype but didn't understand the capital structure. The question you need to ask yourself is, has the thesis changed? If you bought because you believe molecular marking is the future of ESG compliance, then today's price action, while painful, is noise. If you bought because you thought it was a get-rich-quick scheme, you are learning a hard lesson in liquidity risk. We must also contextualize this within the broader sector of investment help and self-investing. Many new investors are turning to SoFi Robo-Advisor or Fidelity IRAs for stability, but allocate a small portion of their portfolio to lotto tickets like SMX. This barbell strategy is common. You have 90% of your money in safe, boring Fidelity mutual funds and 10% in high beta names like SMX. The problem arises when that 10% becomes the emotional focus of your entire portfolio. You obsess over the SMX chart while ignoring the steady gains in your Schwab Intelligent portfolios. It is vital to keep this perspective. SMX is a venture capital style bet that happens to be publicly traded. It has the failure rate of a startup, not the safety of a blue chip. Let's look at the technicals of the move. The stock had resistance around the $200 mark post-split.